Hello and welcome. In this video, we will learn about a few features of IPO. Okay? IPO or initial public offering is the first time a company offers its shares to the public. Okay? This is also called as going public. Alright. So when you hear someone saying the company is going public, it means that the company is going for an IPO. Okay. When a company goes public, it is no longer just owned by founders or private investors. It is owned by anyone who buys its stock. This process gives the company access to a much larger pool of money that can be used for expansion, paying off loans, or investing in new projects. Alright. For example, if you think about companies like Zomato, Nika, or any other companies, each of these companies had an IPO at some point in their history. And before the IPO, they were privately owned, mostly by founders, early investors, and employees. But after the IPO, the public could buy shares and own part of these businesses. Alright. There are several reasons as to why companies choose to go public in the first place. The first is to raise capital. Going public allows companies to raise significant amounts of money to fund new projects, acquisitions, or expansion. The second is to increase brand awareness. An IPO brings a lot of attention to a company, and being listed on a major stock exchange can increase credibility and brand recognition. The third is to allow early investors to exit. An IPO gives early investors like venture capitalists or founders a chance to sell some of their shares and cash out on their investment. And the fourth reason is to attract top talent. Public companies can offer stock options to employees, making it easier to attract and retain them. Okay. Now, the IPO process is complex and involves several key steps. First, the company hires investment banks to underwrite the IPO. These banks help determine how much the company is worth, how many shares to sell, and at what price. Next, the company files a draft red herring prospectus or a DRHP with SEBI. SEBI is the regulator that ensures the process is transparent and protects investor interests. And a draft red herring prospectus is a preliminary document filed with SEBI by the companies planning to go for an IPO. It contains comprehensive information about the company, including the things or what the business does, the financials of the company, and management. Now, this allows SEBI to review the company. Okay. And once SEBI approves, the company goes on a road show, meeting with large investors to generate interest in the IPO. And finally, the company's shares are allotted in a primary market, and then it goes on to the secondary market where the public can start buying and selling the shares. Okay, we will learn about the primary market and the secondary market in the next video. All right, now what you must know and remember is that once the IPO happens, the stock price is determined by supply and demand. Meaning, if more people want to buy the stock, the price goes up. If more people want to sell, the price goes down. All right. Investing in IPOs can be exciting, but it also comes with risks. Some IPOs soar right after they go public, while others do not perform well. Okay, so it is important to do your research before investing in an IPO. Not every company that goes public is guaranteed to succeed, and stock prices can fluctuate wildly in the first days or first few weeks after an IPO. Okay, so an IPO is one of the biggest milestones in a company's journey. It marks the moment when a private business opens its doors to the public, giving regular investors a chance to own a piece of it. All right.